What's going on, guys? Welcome back to another video. In this video, I've got another very important AMC update to bring all of you this afternoon. So what we're going to be covering in this update is a little bit of the Ortex data. There are some key things that I want to point out to you guys. There are some data points that are actually looking very, very good going into the next couple of weeks. And we also have something very interesting going on with the option chain over the next couple of weeks. Now, I know we've talked about the option chain a lot. We kind of just passed one of the largest option chains that we've seen on AMC to date. But I think over this past week, people are finally starting to educate themselves on the power of options and exactly what we need to see on the options chain in order to give us a good chance of running to the upside. And we're finally starting to see that type of action occurring on our options chain rather than some of these other stocks that we've really seen start to take off, which I think is a very, very good sign. Now, in addition to this, we also have to talk about this situation with Goldman Sachs increasing their position by about 85%. Now, there's some really weird things going on with this filing. It is incredibly delayed. These numbers are from the third quarter, but the filing has just recently came out. So we're going to be going over that, what that means in terms of the likelihood of them lending out these shares. Remember, Goldman Sachs is the largest prime broker operation, and they make them a lot of their money by loaning out securities. Now, typically they do this on high cost to borrow stocks. AMC currently right now is not a high cost to borrow stock, but there is kind of a new way that these institutions are kind of manipulating the data in kind of using this manipulative tactic to really benefit the institutions that are short on AMC that I want to explain to you guys. So before we get into all of that information, if you enjoyed the information and analysis that I provide for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So we ended up closing Friday at $17.97. I know there was a lot of talk at buying at the end of the day, but when we take a look at these volume candles right down here at when everybody really wanted to start to get in, the volume candles that really started to come in weren't really anything out of the ordinary. We saw this big volume candle right here on the 5-minute chart, 1.4 million. And then the only one that kind of didn't make a whole lot of sense was this big green volume candle right here, and we didn't really see it reflected in the price action. So again, guys, we are battling against a system that is designed to not help out retail. So we are most likely going to be at this for a while, which I have been saying for a long period of time. But again, as we're going to see, the shorts have not covered. They're adding to their position, and the apes are not leaving. So when we come over to the Ortex data right here, low utilization now, and that is going to play into a lot of the things that we're going to be talking about. We have about estimated 17.78% short interest. But again, these are just the bare baseline minimum numbers. These are not accounting for any of the, quote, synthetic or naked short positions most likely out in the market at this time, kind of given to us by the amount of FTDs that we have seen in the past. But what I do want to take a look at here are a couple of these data metrics that I'm looking at. So the purple line is going to be average days on loan right here, meaning that they're starting to create a new danger zone. When you see the average days on loan start to decrease, it means they're shorting the stock more. And then when you see the days to cover, that's essentially telling you how many days it would take the shorts at the current time to get out of their positions on basically based on a volume metric over a certain time frame in the past. In this case, it's going to be 3 months. So when we see that number go up, it makes it more difficult for these shorts to get out of their position. Now, the last time the days to cover peaked was on December 15th. What ended up happening after that day? Well, when we come over to the daily chart right here on AMC, we can see right here is going to be December 14th. That's kind of where it peaked. And then we ran from the low 20s all the way up into the $30 range. So the data is starting to kind of bend in our favor over here. Now, I want to get into some things on the option chain. So when we come over to Stonko Tracker right here, we can see that there was a lot of contracts that expired worthless on AMC over this past week. We needed the option chain to set up a little bit better and honestly more efficient in order to see that run to the upside. But what I want to explain to you guys right now is I think everybody is starting to really understand how the options are affecting the market makers and the actual price action. So the at-the-money and in-the-money calls are going to have more of an effect on the overall price action, and they're going to be a less risky investment. Now, when there is less risk, there is going to be less potential for a crazy gain when you see a massive run. But again, you kind of got to balance those two things. But when we come over to the option chain for AMC, well, for this next week, again, this is a weekly options expiration date, which is typically going to have less volume and less open interest. And it is also coming after a giant options expiration date. So if you were going to see a lot of open interest or volume, you would have expected it to come in for that Friday expiration day, a couple of days or yesterday. So when we look at this volume right here, we can see that there's 15,000 at 20, 11,000 at 19, and 11,000 at 18. These in the money and at the money contracts are starting to filter in. Now, when you think about this right here, well, now what would be the volume typically on the furthest out of the money strike going into the next week? Well, typically we'd see a lot of volume start to come in and a lot of open interest start to pile up. Now, yes, when we come down here, there is a decent amount of open interest, but the volume is a lot lower on these strikes than what we're seeing at the monies. That is a very, very good thing to see. Now, if you guys have been paying attention to some of the videos and the live streams that I've been doing in the past, you know that we've talked a lot about that range of max pain and what we would need to see in order for the market makers to really have the pressure put on them. And that's the buying of these at the money, in the money calls. Now, this isn't financial advice at all. This is just trying to educate everybody on how the price movements are going to get affected by options coming in terms of open interest. What are the at the monies, in the monies going to do versus the furthest out of the money strikes? So if we can continue to see this type of action on the option chain going forward, this is really going to cause a significant issue for the market makers because it is going to push the max pain down. It's going to be easier for us to break to the upside of that max pain range in order for the market makers to finally start hedging these contracts that they are selling. And that hedging comes in the form of buying pressure. So now let's get into this situation with Goldman Sachs right now. So coming over to Fintel, we can see right here that Goldman Sachs, the reporting date of this filing is January 20th. Now, again, when these filings come out, there's going to be a reported date and an effective date. So the reported date is not where they actually bought the shares, sold the shares, or did anything with their options positions. You have to look at what the effective date is. Now, when we look at this, we see that they closed their call position, they added to their share position, and increased their put position as well. So when we look at this right here, it's interesting. Goldman Sachs added 85% to their share position. They have 1.1 million shares right now. But when we click on this right here and we come over to this page, we can see that the effective date of this filing is the third quarter of 2021. What are they doing here? What is the SEC doing about this? This is such a delayed filing. How are retail investors going to essentially be able to look at the data, what these institutions are doing, if they are just allowed to essentially push out these amendments as far as possible? Now, the other thing that a lot of people like to bring up when we talk about institutional purchases is, well, they're just loaning out shares. They're using it against us right now. And you're not going to see any of the, quote, synthetic positions reflected in the short interest. Yes, that is obviously correct. The other thing that we need to think about here, though, is what is the benefit to an organization like Goldman Sachs right now to just buy shares and then loan them out? Well, when we come over to the Ortex data right here, the cost to borrow average is about 1%. Now, that's a yearly rate. That's not a daily rate. So the cost to borrow is not really going to account for the decrease that we've seen in the past of AMC shares. So it doesn't make a whole lot of sense for them to just buy shares and loan them out. And the other thing is that they're typically going to be loaning out shares that they can just locate. So from a lot of their customers' accounts, just at Goldman Sachs. Goldman Sachs themselves are not going to be doing a lot of this share lending because there's a lot of overhead for them to do that. They actually have to put up the money, go out and buy the shares, and then loan them out. That's not really something they want to do. Now, here's what these institutions either on purpose or inadvertently have been doing in order to kind of mess with our data and take the pressure off the shorts. So we know that there's been a lot of institutional purchases of AMC over the last year. What this does, well, we kind of know that a lot of these institutions lever up all the time. So when you think about these margin accounts, whoever they're trading through is able to loan out these shares if they're not going to be made in cash. The purchases would not be made in cash. So if it's in a margin account, they can loan them out, and there's not really much the institution can do about this. The problem is here is it doesn't actually look like the shares are going out on loan. in a large enough fashion to counteract that utilization equation to basically put that scarcity into the securities lending market. We can see right here the exchange reported short interest. And again, guys, these numbers are going to be messed with. These are just bare baseline minimums, but we know what the institutions are buying. They're going to have more shares, and that's going to mess with some of these numbers. So we can see that the exchange reported short interest reached a high over here of about 97 million shares. We just got back up to, on the last time that these numbers came out, of about 96.7 million shares. So it's kind of stayed pretty flat over the last 2 quarters. But there's more shares that they're able to loan out, but they're not loaning them. What that does is it lowers the cost to borrow. When there's a lower cost to borrow, the shorts are going to feel a lot more pressure. But when there's a lower cost to borrow, the shorts are going to feel less pressure. Sorry about that. So the other thing that we need to think about here is, remember, AMC and GME and a lot of these other stocks are linked. GameStop has not really had as much institutional ownership increases as AMC has. And when we come over and take a look at GameStop's Ortex data right here, we can see, let's pull up the utilization really quickly right here. The utilization has skyrocketed. We're starting to see that increase in the cost to borrow, the short interest, and the utilization. So when we think about the pressure getting put on the shorts, most likely the shorts are shorting AMC and GME together, and a lot of these other stocks too. So if they're going to get the pressure put on them from one of these other stocks, that's perfectly fine. They're most likely both going to run together. So going into the next couple of weeks, again, I know some people might be a little bit disappointed about what happened over this last week and trying to get that price pushed to 21. What you really got to realize, though, is that when you think about trying to push that price to 21, I guess was the number, at the end of the day, well, we were trading in that $17, $18 range. If the price were to skyrocket randomly, you're most likely going to get halted into close, just like that CFV stock that we were looking at on stream. So again, guys, shorts have not covered. We are still in this. The fundamentals of this business are continually getting better off of the pandemic lows. And in my opinion, we are still in the driver's seat. So that is going to wrap up this update on AMC. If you enjoyed this, the information and analysis that I provided for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So I hope you guys are having a great weekend, and I'll see you guys in the next one.